For families that have accumulated significant wealth beyond what they simply need to cover their expenses in retirement, they have an opportunity to leave a legacy for the next generation, for their children and grandchildren. And in addition, they may have an opportunity to support a cause that they care about in the community. Peak Wealth Planning specializes in working with clients with $2 million to $100 million in investable assets. You can set up a discovery call with one of our team members. They'll collect some information. I'll personally review that information and schedule a call with you, and we can determine if we're a good fit to work together and help you meet the goals that are important to you and your family. Perhaps it's a performing arts center or scholarship at a university. And it's important when you're thinking about how to monetize or provide financial numbers behind these legacies to determine what the right amount to give is to your children, to your grandchildren, and when to give those funds. Do you want to give money to your children while you're still living and have them see the benefits directly when they have a new house, or perhaps you've paid for a master's degree for one of your children? Or are you okay with leaving money in your will, knowing that they may not inherit those funds until much later in life, and they might be passing those funds as a legacy to the next generation? A values-based inventory can identify what's important to individual. And let's take the example of education. We work with a family who says education is very important. It's what helped propel us to start our business and be successful. And the university we are involved with help provide interns for the business we have and even education for our employees. So when that institution becomes very important to us, and we've moved from just valuing education to seeing how it helps propel people and the community forward, then that becomes so meaningful that if we build up enough wealth, we might want to leave some of that wealth back to that institution to continue and perpetuate that virtuous cycle. So there's probably three types of charitable giving that we should address. The first is just simply direct giving. You can give a cash gift each year to a charity, and if you're earning a regular income, that can reduce your regular income as long as you're itemizing your tax deductions. The second type of giving might involve giving a large sum to a donor advised fund. And the benefit of doing that is perhaps you have an asset that's greatly appreciated. Maybe you bought a stock many years ago and now it's worth $15 million. And you say that's appreciated. I don't want to pay the income tax on selling the stock and pay the capital gain. So I'll give 5 million of that 15 million to a donor advised fund. I don't have a tax consequence by giving that $5 million to the donor advised fund. All the money stays in the fund. There's no money going to the federal government for taxes. And then that 5 million is reinvested in a diversified portfolio. And then potentially 5% of that value every year could be granted to a public charity. So there's a real nice mechanism to transfer appreciated assets, whether they're in an individual retirement account or a stock or a fund with capital gains, and in some cases, even private assets like privately held company shares. You can move those into a donor advised fund, and then donor advised funds allow you or your family members to make annual gifts to qualified public charities year in and year out. The other benefit of a donor advised fund is it's flexible. You don't have to make a gift from their fund every year. Perhaps you want to make a large gift one year and you want to pause for a couple of years and then you want to involve your children. A donor advised fund provides a lot of flexibility. The second type of significant giving opportunity that families may have is what's called a charitable remainder trust. A charitable remainder trust has a different set of goals that a family might achieve by using that vehicle. So let's take the example of a university, and the family wants to support a university foundation with money going to scholarships for a particular academic program that maybe the mother was involved with while she was in university. Maybe she volunteered for a music program throughout her decades of working. So the family says, we're going to give $3 million to a university foundation to support the music department. But in our retirement years, we want income to go to the husband and wife that gave the donation. And the university says, that's wonderful. We'll pay you $100,000 a year as an example. You've given this gift of $3 million. And when the mom and dad pass away, we're actually going to continue the $100,000 a year for your eldest son because he's had some rough times in life and you want to take care of him. But then after your eldest son passes away, what's remaining from that gift will go to support the music department in perpetuity. So there can be a virtuous cycle of supporting the parents from the gift to the foundation, then maybe supporting the next generation, and then everything that's left over goes to the organization, and then they keep the funds in perpetuity. Donor charitable remainder trust doesn't have to support multiple generations. It can support one generation, and then potentially a larger amount goes to the organization, and they might get it sooner. So it's important to talk with not only your financial advisor, but the charitable organization you want to support about how to structure that charitable remainder trust. A family foundation is a much more flexible arrangement that can be set up where you can support individuals, private foundations, as well as public charities recognized by the IRS. But generally, they involved a lot more cost and administration to set up than a donor advised fund or a charitable remainder trust. So family foundations are typically reserved for individuals with very large asset bases, and you need to involve the proper attorneys and CPAs to set up your own family foundation. It doesn't mean it shouldn't be done, but it's typically a vehicle for the ultra wealthy. I would generally say that might be for someone with more than $100 million in assets. The benefit of creating a comprehensive financial plan is to prioritize your financial needs along with your values and put those side by side. So perhaps you've identified how much money you and your spouse need to live for the next 27 years that will get you to age 105. And once you have an idea of what assets you need to deliver that income, your financial advisor can help you project what's left over for legacy. And then you can make an informed decision. Let's say that legacy bucket is $5 million. You might say, well, I can give away $1 million of that legacy bucket in the next 10 years so I can go to these organizations and maybe I want some recognition for my gift. I don't want to be anonymous. And I can give away some of that money while I'm living. Alternatively, I can say, you know what, I want to be more conservative in my planning, and I don't want to give away that $5 million, even though my financial forecast says I could. So I'm actually going to give that money to a charitable remainder trust, the $5 million, and know I'm going to get an income stream of $200,000 a year. But when myself and my wife pass away, then the $5 million stays with the charity that I wanted to support. So there's some flexibility in terms of options, but I think it's really about identifying what's absolutely necessary and what generations you want to take care of in your family first, and squaring that or juxtaposing that with your philanthropic goals. And the values you have will help drive what causes you support and where and when you want to support family members. And then the financial numbers will help you ascertain how much of your wealth you can assign to each one of those areas that are important to you.